Every generation believes it's finally found a way to turn the stock market upside down. In 2021, that miracle supposedly arrived in the form of meme stocks, a failing video game retailer, a struggling movie theater chain. Companies most analysts had written off as relics, suddenly treated like weapons in a financial revolution. A crowd of small traders with smartphones and a shared sense of anger sent their prices soaring. Billion-dollar hedge funds were forced to cover short positions at breathtaking losses. Screenshots of massive gains spread like wildfire. Comment sections filled with celebrations. This time, the little guy won. That's the story people wanted to believe. But markets have a habit of punishing comforting stories. When the smoke cleared, the harder questions stayed behind. If a crowd with an app can briefly blow up hedge funds, who actually ends up holding the bag when prices come back to earth? If a short squeeze can push a stock into the stratosphere, what happens to all the traders who arrive late, convinced they were part of a revolution that had already begun to unwind? Did the crowd finally beat the system? Or did the system simply find a more efficient way to feed on the crowd's energy, anger, and attention? Nothing about meme stocks was as new as it looked. Beneath the hashtags and emojis sat a pattern that has been repeating for centuries. A new technology that connects speculators, a story that spreads faster than caution, leverage that amplifies every mistake, and someone on the wrong side of the bet. The only real innovation was the app in the palm of a hand and the speed at which belief could go viral. Long before Reddit, before zero commission trading and phone notifications, there were London coffee houses. In the late 1600s and early 1700s, the beating heart of the financial world wasn't a skyscraper. It was a smoky room full of merchants, speculators, and gossip. Stocks were traded on scraps of paper, prices moved on rumors shouted across a crowded floor. The South Sea bubble inflated there not because of sophisticated analysis, but because of a story people wanted desperately to believe. This company will unlock endless riches. Ordinary people poured money into shares because everyone around them seemed to be doing the same. The language changes over time, but the psychology doesn't. Everyone is in this. You don't want to miss it. Or tas. That line could be whispered over a wooden table in 1720 or posted under a meme in 2021. The technology improved. The telegraph, then the stock ticker, then radio and newspapers collapsed distances in time. Prices no longer lived only in one city. They flickered across continents. Alongside these tools came bucket shops, storefront operations where people bet on stock price movements without owning any actual shares. With small amounts of cash, factory workers and clerks could gamble on whether a stock would rise or fall. The environment was fast, intoxicating, and carefully tilted in favor of the house. If that sounds familiar, it should. It was an early prototype of the trading app, frictionless, addictive, and designed to keep people playing. But even in those early days, something more dangerous than simple speculation was taking shape. Markets invented a way not just to bet on companies succeeding, but to profit when they fail. That is the logic of the short. Short selling is easier to understand than its jargon suggests. Imagine borrowing an object that isn't yours, a car, a painting, a watch, selling it today, and hoping its price falls so you can buy it back later for less, return it, and keep the difference. That is the core of a short sale. In the stock market, traders borrow shares from someone else, sell them immediately, wait for the price to drop, then buy back the shares at a lower price and return them. If they're right, they keep the spread. If they're wrong, the position starts to bleed. The danger lies in how that risk is structured. When buying a stock the traditional way, loss is limited. The worst that can happen is the company goes to zero. With a short, the logic flips. The potential gain is capped. The price can only fall so far, but the potential loss is theoretically unlimited. A stock can double, triple, or rise tenfold, regardless of what a spreadsheet says it should be worth. When that happens, short sellers are trapped. A broker demands more collateral. Margin calls arrive. At some point, they are forced to buy back the shares at whatever price the market demands, just to close out the burning position. That forced buying is gasoline on an already rising fire. As short sellers swarm to cover their bets, each buy order pushes the price higher, which triggers more panic, more calls, more forced buying. The very people who predicted the fall become fuel for a violent rise. This feedback loop is the short squeeze. It is not a myth. It has toppled fortunes for over a century. In 1901, a brutal short squeeze in the Northern Pacific Railway nearly broke Wall Street. In 2008, Volkswagen briefly became the most valuable company on earth, not because of a sudden explosion in car sales, but because short sellers were trapped in a corner, unable to exit except by paying absurd prices. Each of these events followed the same geometry: heavy short interest, limited supply of shares, and a surge of buying that refused to back down. For most of history, short squeezes were the tools of insiders. Wealthy operators, syndicates, and pools who quietly accumulated stock, then revealed their trap when shorts had no way out. The meme stock era added a new twist. The crowd tried to become the syndicate. By the late 2010s, some companies were obvious targets: a mall-based video game retailer in an age of digital downloads, a theater chain drowning in debt, caught between streaming services and a global pandemic. The logic made sense on paper. These were dinosaurs, and shorting them was simply facing reality. Analysts wrote bearish theses. Hedge funds layered on short positions. Eventually, so many institutions bet against the same companies that short interest climbed to extraordinary levels. It wasn't just a belief anymore. It was an entire segment of the financial system leaning in one direction. With high short interest came fragility. All it would take was a determined group of buyers, enough capital and enough conviction to refuse to sell, and the pressure could reverse. The weak point was visible to anyone who knew where to look, and a growing group of retail traders did exactly that. At the same time, the way people accessed markets had changed. For decades, trading required phone calls and fees. The process demanded effort, and that effort created a natural speed bump. Zero-commission trading apps demolished that barrier. Opening an account became as simple as installing social media. Identity verification, funding, and trading collapsed into a seamless sequence of taps. Charts flashed, green and red sparkled, confetti animations, rewarded executed trades. Cheap options dangled like candy in the interface. Speculation didn't just become accessible, it became gamified. These apps were more than tools. They were behavioral machines. They turned stocks into content and trading into entertainment. Combined with social networks, they created a financial echo chamber where opinions, jokes, price targets, and screenshots spiraled together into a feedback loop. A rumor ceased to be a quiet whisper. It became a trending post. An idea didn't spread over weeks. It exploded in hours. Alone, a small trader could do little. Networked through an app and a social platform, millions could concentrate their actions into a single point. When heavily shorted stocks like GameStop and AMC collided with that collective force, the result was inevitable. Traders found data showing that more shares were promised to buyers than practically existed in free float. They recognized the vulnerability. A simple narrative solidified. Hedge funds had become arrogant, shorting a company past the point of prudence. If enough individuals bought and held, those funds would be forced to pay almost any price to close their positions. The story carried a moral edge. This wasn't just a speculative play, it was payback for years of perceived injustice, especially the 2008 crisis where ordinary people watched institutions get rescued while their own livelihoods evaporated. Money poured in from phones around the world. Small accounts bought shares. Others bought call options, side bets that the stock would rise further. Those options created their own secondary pressure. To hedge the risk of selling calls, market makers bought the underlying stock. Rising prices forced them to buy even more. The squeeze intensified. As charts went vertical, paper gains reached millions for some. Short sellers bled. Some funds took colossal losses. Others needed emergency capital. For a brief period, the narrative lines were clear. The crowd was winning. The giants were stumbling. But markets rarely allow a simple good versus evil script to run to a clean conclusion. As prices climbed, new participants rushed in, not with careful strategy, but with fear of missing out on life-changing returns. They bought at higher and higher levels, convinced the worst fate was being left behind. At the same time, some early entrants quietly sold into their enthusiasm, locking in profits while the story still looked invincible from the outside. In the middle of that storm, the plumbing of the financial system suddenly showed its limits. Trading platforms started restricting purchases of specific meme stocks. In some cases, traders could sell their positions, but not buy more. Official explanations pointed to clearinghouse requirements and capital constraints, back-end risk controls stretched by unprecedented volumes. For many in the crowd, it felt like the game had been rigged in real time, the rules rewritten mid-hand to protect larger players. The outcome was brutally familiar: violent swings, then a collapse from the peak. Some retail traders walked away with enough profit to change their lives. Many others were left holding shares purchased near the top, watching their accounts drain as the story cooled. The short squeeze had been real. The pain for hedge funds had been real. But the belief that the crowd had broken the system turned out to be temporary. Behind those dramatic moves, a quieter beneficiary was collecting a toll on every trade. Zero commission did not mean zero revenue. Trading apps made money by routing orders to high-speed trading firms that paid for the right to execute them. That payment, called order flow, turned retail excitement into raw material. Market makers earned small profits on spreads, multiplied by massive volume. Platforms gained data on behavior patterns. Even as memes framed the saga as a war, the pipes below were sending a steady stream of income to firms designed to profit from volatility, not be destroyed by it. The deeper pattern becomes easier to see at a distance. In every era of speculation, the infrastructure benefits. The bucket shops of the early 1900s made money regardless of who won or lost individual bets. Exchanges earned fees while fortunes rose and fell. Brokers collected commissions whether customers outperformed or lagged. But the meme stock frenzy didn't overturn that logic. It accelerated it. The more people traded in a rage and hope or in solidarity, the more the structure underneath earned predictable, relatively low-risk income. Meaningful power did appear, but it was not as absolute as celebratory posts suggested. The crowd demonstrated that it could identify structural weaknesses like extreme short interest and exploit them. It showed that a collective of small actors could move prices in ways large institutions could no longer ignore. But the crowd also revealed its own vulnerabilities: susceptibility to narrative, to herd behavior, to emotional whiplash. Short squeezes driven by coordinated buying can cause spectacular moves, but they are time-limited. Once the shorts are out, once leverage is reduced, the gravitational pull of business reality returns. Revenue, debt, competition, and long-term viability matter again. Stocks that soared on pure pressure drift back toward whatever value the market ultimately believes they deserve. Underneath the drama sits a harsh truth. Financial manias are always transfers. Wealth moves from latecomers to early movers, from the emotional to the calculated, from those who confuse participation with power to those who understand structure. The rhetoric around meme stocks framed the episode as a class war, a rebellion, a reckoning. Yet the underlying engine remained the same as it was in the South Sea bubble or the bucket shops or the day trading boom of the late 1990s. Hope and anger bring people in. Leverage magnifies their decisions. Infrastructure takes its cut. A handful of traders exit early. Many find out the hard way that being on the right side of a story doesn't always mean being on the right side of a trade. None of that means the crowd is doomed to lose. It means the crowd is not exempt from the rules of risk, liquidity, and human psychology just because its motives feel righteous. There will be another target, another stock, another asset wrapped in a story that promises not just profit, but justice. There will be talk of punishment, of finally making them pay. The details will change. The rhythm will not. A technology will connect speculators more tightly. A narrative will make risk feel like duty. Some group somewhere will be overexposed. The cycle will spin once more. The real lesson of meme stocks lives between the lines of the headlines. Apps are not neutral tools. They are products built to maximize engagement. Markets are not moral arbiters. They are mechanisms that match orders and clear trades. Stories are not strategies. They are recruiting tools. The crowd, the app, and the short squeeze form a triangle of potential and danger. The crowd brings the energy. The app channels it. The short squeeze offers a tempting target. But unless someone in that triangle understands when to enter, and more importantly, when to leave, the result is the same as it has always been. A handful emerge with gains that look miraculous, and a multitude are left wondering how something that felt so right went so wrong so quickly. The next time a stock goes vertical because a community has decided to hold at all costs, it's worth asking a quieter, less glamorous question. Who is structurally forced to buy if this goes against them, and who can simply walk away? Who collects fees on every trade, regardless of outcome? Who benefits from the data generated by millions of frantic taps? Who can halt trading, adjust collateral requirements, or change rules if volatility threatens their position? And who, in contrast, is left with only belief? Meme stocks pulled back the curtain on the modern market far more than most official reports ever could. They showed that coordination can be powerful, that structural vulnerabilities exist even in sophisticated systems, and that crowds are capable of forcing billion-dollar decisions. They also showed that without a clear understanding of the machinery beneath the tickers, those same crowds can be turned into fuel, feeding the very system they set out to challenge. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.